Good morning and welcome to Purpose Driven Finances, where our focus is helping you use your finances to achieve the purpose and plan for your life. And now here's the host of Purpose Driven Finances, Allan Molina with Serwus Capital Management.
Hey, good morning. This is Allan Molina, your host, Purpose Driven Finances, president of Serwus Capital Management. How are you doing this glorious weekend? I realize fall is one of my favorite times of the year. The leaves changing, falling. I'm just glad I'm living on a little bit of a hill. That way it blows them all off into the woods. But sitting here with my friend, my co-host, the guy who had the idea of starting the show, Rich Roth. How you doing, man?
I'm always skeptical when people start, coming up with, what would they be, adjectives to describe me?
Mm-hmm.
Always skeptical of that.
Well, mine was 100% true.
Yours was good.
Exactly.
Yours was good.
Because I value you, man, and I appreciate you. And I was going through, because I'm redoing my website, so folks, it'll probably be done. And the company wants to get it done in like 3 weeks. It's probably going to be 6 or 8 from now. Just because
they're a hassle, man.
They are.
Because we'll do simple ones for businesses who just want, a splash page or just an online presence so that you're a real business. Right. And, they're like, oh, no big deal, just a few pages. But you need to get so much content on those few pages and it takes time.
Right. But the thing that the lady I'm working with has done a great job with the look and the feel and the modern and catching that. But we only probably talked on through Zoom like an hour and 15 minutes. Mm-hmm. And I felt bad because she really can't do a good job of capturing all that I do in that amount of time.
Right.
And it's not anything special, but
oh, you're special.
Oh, yeah. Yeah. I'm a handful. Yeah. But I felt bad for her. And so I was like, hey, what I'm going to do is I'm going to provide a lot of the content. And the other issue that I don't know if you've come across this, but a lot of times these web companies and individuals will say, hey, we want to redo your website. And they make it to where it's pleasing to whoever pays the money. Mm-hmm. But it's horrible at SEO, search engine optimization. Mm-hmm. And she has no idea. And so I'm working with Google on actually making it to where they like it. Mm-hmm. And then, and people are like, Allan, we don't care. We just want to know about finances and how it can help us achieve the purpose and plan for our life. Do you like fall, Rich? I know you don't like leaves, but besides that.
I do. I like fall. You want to hear a quick story?
I would love it.
It's not quite R, probably PG-13.
Well,
a little risque for a financial show.
Okay.
But, nothing over the top. It's funny more than anything.
My wife is like, come on, Rich.
She wants to hear it?
No, she's like.
Oh, she's like, no?
Yeah. But go ahead. Hit me with the digits.
Are you sure?
I don't know.
So you're talking about fall. I'm getting ready to do some stuff to my lawn, right? Mm-hmm. Throw down some fertilizer, right, whatever. And I'm in a store picking up that stuff. And I grab a container of Virginia Diner peanuts, and the grass seed and the fertilizer come in big bags. And the lady behind the counter looks at me and she goes, oh, do you want your nuts in a bag? And I just look at her and she was so embarrassed.
Yep.
And I'm like, nope, already good there.
Right. Yeah, that's funny. Yeah.
But she was, oh, I'm so sorry, so apologetic. But it was,
right.
I'm like, thank you. You made my day.
Yeah, exactly. Well, I there's some people out there who listen to the radio show on a regular basis, like, Allan, what in the world did Rich just say?
Sorry.
And then I have some clients who are laughing.
But it was peanuts.
Exactly, peanuts. So, it's all good. But those, what are those? What's that type of English where it can mean two meanings? Not onomatopoeia. That's when it sounds
double
like
entendre.
Yeah, double entendre. Yep. So everybody learned something new.
I'm a big fan of those.
Exactly. So am I. But folks, let's talk. The first section that we're going to talk about is talking about your portfolio. But then what's interesting is the second half of the show, what's my number for investment planning? Because a lot of people look at financial planning as, like last week we talked about retirement planning. Next week we'll talk about something else regarding what's my number. We have about another probably 5 or 6 weeks to go in that. But today we're going to be talking about what's my number for investment planning. And you're like, Allan, that's kind of fuzzy. But it's critical because...
And it's different than retirement planning.
It is. It's retirement because it's basically, well, it's an area that people don't think about, but it's very important.
All right. I don't want to jump the shark here.
Okay.
So
I appreciate that.
That's next segment.
That's
right
next
now,
segment.
I was hoping we could talk a little bit about the Fed.
Hey, that's great. I appreciate that. I know that was on top of your list. Looking forward to the Fed.
Quarter point cut.
A quarter point cut. And what's interesting is during the day, there was a lot of consternation on Wednesday. The market went up, market went down. The market didn't really know how to deal with it because they wanted half a point. The very few wanted 0, but poly markets, what's interesting about poly markets are being used more than a lot of the stock market or the bond,
Well, explain to folks what poly markets are.
Poly market is basically just a place where people bet on where things are going to be, whatever the subject is. Who's going to be the next Fed chair? Who's actually, one of them is Trump going to actually be found that the newest tariffs that he did, or the tariffs that he did, are actually the policy, not the policy, but the law that he used was illegal by the Supreme Court. I think last time I heard it was a 43% chance. But Polymarket had this idea, and so a lot of firms and people are looking at Polymarket because at times it's more accurate. And then on top of that, looking at the 2-year yield, looking at the U.S. dollar, they were signaling, and gold, they were signaling that the Fed was going to cut, but some to half a point. But they cut a quarter point. The big move wasn't until Thursday, Rich. Of all the stocks, that's probably a dumb question, but I'm going to ask anyway. We have large cap, mid cap, small cap, micro cap, crap cap. What I mean by that is stocks that are very poor. We have international, whatever country. What do you think was the biggest mover asset-wise? And the reason I'm asking you this is because you used to be in the industry and you know these things. The asset class. Let's just do
that was the biggest mover because of what?
What the Fed did. I'll even narrow it down to three of them. Large cap, mid cap, or small cap.
Okay, all right. So you're talking stocks because I was going to go bonds.
Well, bonds did go down. Long-term bonds did go down in value, which was rather interesting.
Interest rates go down. I'm going to say that this is a somewhat educated guess, but I'm going to say large cap.
Nope.
I meant mid cap.
Nope.
Small.
Yeah.
Yes.
Small. Woo,
I got it. I got it.
Yep.
Why?
Because it's looked upon as small caps are more dependent on interest rate moves because normally small caps are lower rated. Mm-hmm. Therefore, their interest rates, their expenses higher because like a Google is probably AAA rated or AA rated. Mm-hmm. So the interest rate that they get in the market is much lower than, say, a high-quality small cap. Their interest rate's probably going to be higher if they go to market. And what I'm saying is 2+%. Whereas large cap was, I think, around 1.25, something like that. Significant outperformance. So it's very interesting. And what's interesting is when I was at, I don't know why these firms don't want to be named, but I mean, it's on my ADV. Everybody knows when I was at Morgan Stanley, I'm going to just name it. I asked one of the guys, one of the vice presidents, if small cap is a significant outperformer, why don't you overweight it? And like, we do overweight it. I'm like, we went from 2% to 3% of your portfolio. Like, woo.
I feel like it's time for a disclaimer.
What?
The opinions expressed by Allan Molina and Cerus Capital Management do not necessarily reflect those of James River Media or WLNI Radio.
Why was that?
I don't know. Just when you start naming firms.
No. Everybody knows that I used to work at those two firms. I didn't say anything negative about them.
I was just kidding around.
Yeah, I appreciate it. I didn't say anything
but
negative.
But the disclaimer still holds.
Yeah, I appreciate that. I didn't say anything negative about it.
I am teasing.
And because, all I got to do is look at my record and what I mean by my employment
your ADV,
record.
Yeah.
The firms I worked at. I mean, you even know where I worked with before Morgan Stanley, which was Liberty University. But that being said, it's interesting because as a whole, small cap is severely underweighted compared to other asset classes. And so it'll be interesting to see what happens the next 3 to 6 months. But the Fed, lowered interest rates, and
how much of a difference is that going to make realistically? 1/4 of a point, not much.
It won't make much of a difference. But what's going to be interesting,
and I understand. Please correct me if I'm wrong, and I know you will.
Maybe,
but that really didn't have much impact on the 10-year, which is the one that's impacting mortgage rates.
Right. Actually, if I'm correct, I don't have the chart in front of me, but I believe the 10-year Treasury actually went up in yield. What's interesting is when they started lowering interest rates last year, when the day of was the low of those interest rates, and they actually went up. So hopefully that doesn't happen again. It's my expectation that interest rates are going to be creeping down. But the problem is we're going into a cycle of about 3 or 4 months of inflation going up. So the Fed's going to be hard pressed in order to lower more. But we'll see. And a lot of people are saying, my wife, she's dealt with me through many firms, and all the research that I've done and analysis and learning and things such as that. So she was like, is that good or bad? And she knows that when they're lowering interest rates, it's usually a moniker of a slowing economy. What's interesting that I don't know if the interest rates and the unemployment data, if they've ever dealt with fraud. And what I mean by fraud is the Federal Reserve looks at the unemployment data, and then they look at GDP and other issues. I'm making it very simplistic, but once they do that, what they do is they then do their forecast of interest rates according to those two things. But we've talked about on the show, Rich, that over the past 2 years, there was 1.7 million jobs that weren't really created, that were reported. And so I would expect that the Federal Reserve has a very tough time of really doing interest rates accordingly.
Okay.
And I would think that's very difficult to say. But the exciting part is we're going into a quad 2 for the fourth quarter.
Quad 2's really good.
It is good.
Quad 1's the best.
It is.
Quad 4's the worst.
Exactly. Quad 2 is basically growth is going up, inflation's going up. So it's going to be a very interesting time in order to position your portfolio. I've been positioning slowly for Quad 2. And to give you an example, this is where I need to do a disclaimer. Past performance is no indicative of future results. Okay?
Yeah.
But on Thursday, markets, we were positioned for more of a Quad 2 day. And our 50% stock, 50% bond portfolio beat the S&P 500.
Wow.
And it's just because we were positioned for the Quad 2 days. And so it's going to be interesting to see what happens. Now, folks, we've had a lot of exciting things. We've heard a new disclaimer from James River Media. I appreciate that, Rich.
You're welcome.
And
CYA mode, baby.
I don't know why. I didn't say anything disparaging about any of them.
I know.
But this is Allan, host of Purpose Driven Finances, president of Cerus Capital Management. Give me a call, 434-316-0246. Stick around. What's my number for investment planning? 30-second break.
This is Chainsaw Talk with Tommy, the Woodsman. Do ladders and tree work mix? A quick internet search will give you the answer. Ladies, if you see your man carrying a ladder and a chainsaw towards your tree, just go ahead and dial 911. There is a reason professional tree companies don't use ladders. When the tips of the branch hit the ground first, they will compress, creating a spring. Unfortunately, this energy is redirected back towards the cut end of the branch and can take the ladder right out from under him. Stick around for more great tips from Tommy, the Woodsman. I have a saw for that.com.
And now, back to Purpose-Driven Finances. Here's Allan Molina with Serwus Capital Management.
Hey, this is Allan Molina, your host, Purpose-Driven Finances, president of Serwus Capital Management. Just reminiscing about friends from old firms that I enjoy. But so, folks, we're talking about what's my number for investment planning. And a lot of times people are like, what's my number for retirement planning? What's my number for my auto insurance, for my homeowner's insurance? And we'll get into those things. We've already talked about retirement planning. But what's my number for investment planning? And you're like, Allan, this is kind of weird. I've never heard really this talked about. Well, it's key and it's critical in order to talk about what's your number for investment planning. And you sit there and you say, Allan, why? Why? Why is it key and critical? There's a test that Rich has loved.
Love it.
And what's that?
The pillow test.
Exactly, the pillow test. And so the pillow test is really if the market's going down 10, 15, 20, 30, 40, 50%, at what point do you get worried and start losing sleep over? Or you're stressing about during the day? And so having a number for your investment planning will dictate the amount of risk that you take. And so, you know, Rich, one thing that I'm always hearing from folks is, let me change that, not always, but often I hear two things. I want to make as much money as I possibly can with little risk. And that doesn't work. Then the other thing I hear is, I want you to manage this as though it was your mama's. And then I say, well, my mom's dead, so that's kind of hard. You know, I'm just, you know.
You're just being real.
I'm just being real. Because that's really an unfair question. And if we go to court of law and they were like, he managed it the way his mama's did, you know, I can't say, well, my mama's dead. You know, so that doesn't work very well. So, but the key there is it does several things. Is why do you need the number? Is one, it avoids blind risk taking. Because if you're like, I want to make as much money as I possibly can. So the problem with that is we can put you in a 3x ETF that's 3 times the market that has a lot of juice to it. It doesn't mean you should be in it. You know, it just doesn't mean you should be in it, because once it goes against you, you're not going to like it. But also balancing growth goals with your risk tolerance. And risk tolerance is one of the hardest things as a financial advisor that I find in order to help people determine. And every client, we go through an investment policy statement in order to help them determine the amount of risk that you actually want to take. Because, you know, Rich, when the markets are going up, everybody's all-time highs, what does everybody want? Risk. But when the market is going down and down and down and down, what do people not want? Risk. And so there needs to be a balance. And then finally, under why you need it, is because instead of tying your investments to a return, you tie your investments to your purpose. Because if your goal is to retire and have, you know, 4 times what you have right now, and you want that in so many years, it's easy to come up with a number in order to get there. You know? So that's the why. Now, here's some numbers, Rich, that matter. And I know I'm talking a lot, Rich. You can ask me anything you want to. feel free. But numbers that matter. First of all, rate of return. That's really what we're talking about. What is the average rate of return that you need in order to meet your goals? You know, Rich, you ever heard of the rule of 72?
I have.
Yeah.
I have.
Yeah. You basically take the number of years you want to double and divide it into 72, and that comes up with your interest rate. If you wanted to double every 10 years, it's basically 7.2% is what you need. And at 7.2, you then can back into how much risk you need to take according to historical averages and indexes. And then, but the other part of the issue is, okay, so you need, let's just pretend 7.2 is the number you need. So what is the worst that can happen with a 7.2% average annual? And how you determine that is you take your index of your S&P 500 and a bond index, mix them up according to percentages, and look at the worst year. 2008 is probably the worst year that you're looking at. At a 7.2%, you're probably looking at a 70% stock portfolio, just looking at the basic indexes.
Mm-hmm.
Worst year of that was 28% down, which is a good amount.
Yeah, that sets you back, right?
But the issue that you have to look at.
But let me ask you this.
Yeah.
Is that factored in to the 10-year?
It is.
Right? Because you're assuming there are going to be good years and
Exactly.
bad years.
You're assuming.
So,
right.
Okay. So you can still, had a bad year, but
right.
I still should be on track.
Right. Exactly. It's just with a 70% stock, 30% bond portfolio, it probably in 2008, it probably didn't recover until 2011, 2012. I'm just educated guessing because I don't have the numbers right in front of me. And so what ends up happening is you say, you know what, Allan, 28% down in the worst year is a little much for me. I was thinking max 22%. Then you're looking at a 60% stock portfolio, maybe, and we're talking S&P 500. And so what ends up happening is then you say, well, you need 7.2 with a 60% stock portfolio. We're probably looking at 6.4. And what I find, Rich, is a lot of times people will look at historical averages of indexes over the past 10 years. That the past 10 years, we really haven't had a significant recession because in 2025, the stock market between February and April went down 25%, but we've eclipsed that. It's recovered. That's not a long, drawn-out, protracted period. 2020, the markets went down about 33%, somewhere in that range. They came back just simply because of the pandemic and the hopes. So that's not really a good time. What you need to do is look at your portfolio over an extended period of time that includes dramatic, long, drawn-out recessions. 2022 was a bad year, but realistically, it came back. I'm talking about 2007, 8, 9, 2000, significant long-term that cooked portfolios for an extended period of time. Then the asset allocation number. We got the rate of return number or the risk number, asset allocation number. And, I've already flowed into it. It's the percentages of stocks, bonds, and alternatives that you need. And then your withdrawal number. What is the percentage that you can take out where you're basically, I don't like to use the word guaranteed, but if you have good returns and you have a low percentage of withdrawal number, you basically will never run out of money. Any questions about that, Rich?
No, not about that, but I want to know how you come up with a number.
Which number?
What do you mean?
We named 5 of them.
Investment number.
The investment number.
Yeah.
The investment number. The withdrawal number, I'm sorry. Oh, and I skipped the savings and contribution number. I skipped that one. How much you need to add annually to meet your goals.
Okay.
So which of those 5 numbers you want me to talk about?
Oh, I'd actually jumped ahead. I just
you
was
did?
looking at the whole thing.
Oh, look at you, bro. Look at you. How do you start with your retirement life goals?
Okay.
I like that. You're ahead of me, as always, Start with your
You know me, Allan. I just want to get to the. I mean, you're over there. You're a detail guy. I'm just Tell me what I need to do.
Exactly. How does it affect? So I appreciate that. See, you're always, because I could talk for like 2 hours.
I know.
You know, is that why you don't let me have an hour show? Drive time with Allan Molina.
Oh boy.
Oh yeah.
Oh boy.
We would jazz it up a little bit.
Oh boy.
It would be fun. Have more sound effects. It would be so much fun.
That's what you want as a comedy investing show.
Well, Kramer has sound effects. I'm not saying that's a good thing.
Is Kramer a guy we really take seriously?
Exactly. Bye. No, just one of those things. Okay, let me get back on track. How does, I appreciate you stepping ahead. How to discover. First of all, you got to figure out what your purpose and plan for your life is. What are your goals? What are your dreams? What are your desires? And then after that, you figure out how much assets you need in order to accomplish that. Either lump sum or how much you need on a monthly basis. And what's I think is interesting is all the firms I've ever been involved with, including my own, Service Capital Management, will do financial planning, and it'll do this long spreadsheet with this long chart and this nice little spreadsheet that create the chart that says you will run out of money when you're 89 or 99 or 109, and 30 years later, and people get so much comfort from that. Do you know how much life is lived between now and 30 years later? And I dare to say 99% of most of those financial plans are not accurate. Simply because, A, you don't get the returns, you don't know the recessions, you don't know the wars, but also you don't know the inflation, you don't know how long you're going to live. I really like to look at it taking a year at a time and say, listen, you need to look at what's going to happen over the next year. But looking at it over the next year, we know the return we need to get on the account, but also how much you need to spend. Because what I have seen is someone will look at their entire account, it's like $1.5 million or $1 million or $500,000, whatever the number that's big to you. And you're like, I can spend 10% and I'm okay. But the problem is you're looking at the big account, not what happens in this year and how it affects the ripple effect.
Right. You take out 10% of 500,000, you're down to 450. Then all of a sudden you lose 25% in the market the next year. And that 450 is down, under 400.
Right.
And now you want to take more money out, and now it's down approaching 300. And
right.
you sit there going, whoa.
What did I do? Exactly. And so back into the return needs and your risk levels. And then you can use simulations and stress tests and check sustainability, which is nice, but that's why I like looking at it a year at a time, because it controls the return, but also the spending and where we're headed. And it really helps. Now, there's a question you haven't asked me yet, Rich.
Which one are you looking for?
Allan, how do you do this in proactively protecting portfolios in order to help them with their number of investment planning?
Okay, that one.
What were you thinking?
Go.
Go.
You got 1 minute.
Hey, here's what we do, Rich. One thing that I have worked very diligently on is proper portfolio management enables people, when I say people, the advisors, in order to try to skip the dramatic drawdowns. We've talked about that. And there's things that you can do, shifting the investments in the quads, that can hopefully limit the 20, 30, 40, 50% drawdowns. Because if you just sit there and experience the stock market and you're down 1 year 63%, it doesn't feel great that you're up 40 the next year.
Yeah.
It really hurts. And so one thing I do is I try to avoid the big drawdowns to help people achieve the purpose and plan for your life. So folks, we talked about a lot, and it's not things that normally are talked about. Give me a call at 434-316-0246. Let's analyze your portfolio to see if it's actually giving you the returns, the diversification, and the help you need. Hope you have a blessed weekend.
Returns for illustrative purpose. This is not a suggestion to buy, sell, or use a platform. Only will a suggestion occur after a meeting to determine goals, risk tolerance, and time horizons. Investments involve risks and no guarantee of future results.